We're officially live on YouTube for the Thursday edition of the Not Your Average Investor Show, the JWB Property Week.
There it is.
I can do both. I can do both. I'm your host, Pablo Gonzalez. We are waiting on GC to show up right now, but it is right now me and our phenomenal community manager. We call her MTM because she brings us the moments that matter, and because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And I think I just heard the door open. But if you were with us on YouTube or listening on the podcast in the future, the best thing to do is go to NYAIS.com, register, because we do this live on Tuesdays and Thursdays, and you get to talk directly to the man that I like to call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you here.
Great to be here. Oh man, we were just telling the community that the only difference here is that you're not down the hallway, you're just down the street, but you normally show up about 30 seconds ago.
That's true. That's true. Yeah. I tell you what, it's such a warm and inviting place. I just show up and get to be myself, and that's awesome for our Thank you guys.
It's amazing. And if you show up on Thursdays on time, unlike Gregg today, you get to be part of what, GC?
The roll call, baby.
Hey, we got John. We got the leadoff batter kicking us off today.
John Hennig.
And we got the ringmaster of the Not Your Average Investor community, Drew Barnhill. We got Big Papa. We love it when he calls him Big Papa.
When he calls him Big
Your
Papa.
hands in the air if you're a true player. It is J. Cohen, Gregg's dad. We got Michael Sartorius in the house. We got Nadeem Shah with his trademark good morning, good afternoon from the West Coast. We got the Milton Manona. Billy Green saying hello from the rainy mountains of Colorado. Who else? We got a Not Your Average guest. If you check in with a text message, then you show up as Not Your Average guest. So let me know what your name is so I can get it right in the chat. We got our regulars, the second family of the Not Your Average Investor Show from Murrieta, California. Gary and Rosalind Riley, we salute you. So we got Mark Mills from Kansas City. Mark is not a regular, but you've been here a couple of times, Mark.
Absolutely. Remember the name.
Good to have you back. We got our friend who is back, Leo Faraganan. We got Joel Almosora, past star of the show, a legend with my team, who is heavily Filipino, and they talk about his story all the time. Very inspiring. Joel, glad to have you back. We got Laura Colby's back from Washington State.
She's becoming a regular.
She is. She's getting pretty regular. We got Maury Leitner, who is from LA. There's a couple times now that Maury's joining the show.
West Coast, I
love it. West Side. We got the first family of the Not Your Average Investor Show, the patriarch and matriarch, Ken and Carolyn Moline. We salute you. We got out here. The man that everybody knows from California.
Noah Randari.
You know that's right. We got, did I say Mark Norman already? Mark Norman in the house, just in case. Making sure we got our bases covered. And I love that segment. But you know what segment I like even more?
What segment?
My favorite segment. When Madison shares good news. What's the good news?
All right, everybody. So we got a really cool email this morning. Came in, was going through my emails, saw one from our director of leasing and property management, Mel, and she was letting the team know that we won the Triple Win Award from Second Nature for leadership and investor experience. So didn't even know that was an award, but it sounds fitting. So I don't know any other property management or turnkey provider that would have even come close to us, but it's a super cool award and just another testament to our team here and the hard work they put in for you guys and our residents and everything. So
I love it. Give some context.
Well, absolutely. So Second Nature is a company we love, and you all should love Second Nature as well, because they improve the resident experience for us. So we have a really strong partnership with them. They have a triple win leadership council that each year actually goes and does an independent search through an independent third-party firm that analyzes the best investor experience across the country for property management companies. And so we're super humbled and grateful that they gave us the award this year for the best investor experience. So big credit to Second Nature for creating the platform for greatness in the property management space. And then it's just really awesome to share this award with our team. So great job, Madison.
Love it. We have a show with Andrew Smallwood from Second Nature. If you go into the research, right? Because they're really just championing. They've become this like champion of the professional property manager, right? We talk about this all the time internally. This idea that there's like the Uncle Sal property manager, and then there's a professional property manager. Do you see in let's give them a little bit of teaser. What are the telltale signs of a professional property manager?
Well, I think the first sign is that you need to have an alignment of goals. Just very simply, you need to understand how that property management company is making more money when you make more money. And there's a number of ways to do that, but the easiest way to look at is, do they sign long-term leases and do they focus on resident retention? Most property management companies don't do that because they don't make more money doing that. So the alignment of goals is critical. Professional property management has world-class customer service. You'll quickly know the difference between that and not world-class customer service. The pick up the phone test. When you call them, do they pick up the phone?
Yeah.
Right. Yeah. And then, this data flywheel component that we talk about so often, it's critical to a high-performing professional organization. That's no different in property management than financial firm or really any high-performing company. So they need to be data-driven and have that commitment to that data flywheel.
The big aha moment for professional management when we were recording the class, which teaser is coming out next week. Don't tell anybody, worst kept secret ever. But is the specialization of labor. I remember when we were explaining on the class, like, well, they got to have a certain amount of people, right? Because if you are a property management company above a certain number of people, then probably what's happening, it's like maybe they have like 4 or 5 property managers, and each one is given a portfolio of properties. And they might have 5 properties, but they got to do the leasing, they got to do the maintenance, they got to do all these different things. If you reach a certain critical size, now you have somebody you have one person that's in charge of making sure that it's rented. You have another person that's in charge of making sure that that property looks great, right? Like you have multiple,
and let's tie it back to what Madison shared as our good news, right? We won this award for investor experience. Yeah. We have an entire team that is dedicated to investor experience. Yeah. They are not dedicated to leasing your homes out. They are not dedicated to handling your maintenance issues. We have another team responsible for each one of those. So there's no way we would win that award for investor experience unless we were specialized. And that's what you should expect from your property management company.
And what you can expect here every Thursday, right after the roll call, is good news. Thanks, Madison. That was awesome. Appreciate it.
Of course.
All right, GC, we got a question already in here from the MVP of the community. You may have heard of him. His name is Lee Bishop. He asks, Pablo, why is Gregg at Pablo's house?
I'm glad you asked. So, I just think it's these moments that I have with my kids who are 10 and 8 years old are just like precious to me. And so whenever I can be at one of their events, I'm always doing whatever I can. Even if it means that I may be a couple minutes late to the show, I'm threading that needle. So today my kids had a special taco lunch where the dads got together and served all the kids tacos at school. And, I had to get some FaceTime with my daughter. So I was waiting. It was funny because she doesn't get served until about 12 or 12:05. And I'm like, all right, can I get the FaceTime? Can I go and give her a hug and still make it in time? And, she didn't come until like 12:10 or 12:15. And I'm like, uh-oh, but we're here now. Yeah. So that's why. That's why I'm late. That's why we're not in the office right now. And you know what? We're gonna roll with it.
I call it not your average Studio East, man. We roll with the punches out here. I got my own thing going on with all the stuff that I do. We can leverage this because Gregg lives close by, and we are here to give you a great experience, like a triple win. So now, what we're actually going to talk about today,
well done,
wait a minute. We got some breaking news, GC. You're rolling late with some breaking news?
I'm coming in strong with not just one bit of breaking news, dose breaking news of us. So I got a little bit of macro breaking news that's really positive for the city of Jacksonville, and then a little internal breaking news that is also very positive. So on the macro side, wanted to share with you, this just was released. Forbes put their list of the top 25 best places to retire together. And this is not a list that Jacksonville has made before, but guess what? Jacksonville was listed in the top 25 of the best places to retire in the country.
Interesting.
Very cool. Yeah. And how do they put this list together? Well, it's based on median home price, crime rate, taxes, air quality, access to healthcare, weather, and natural disaster risks. So super happy that we are being recognized for this wonderful place that we get to live, not just for young, not just for folks that are active in their careers, but even those who are at retirement or nearing retirement.
Did they mention surfing in there?
Surfing is in the top one for Pablo's requirements, not for Forbes.
I remember. So first of all, not surprised.
Right.
Like Florida, great place to retire. Jacksonville, underpriced place for a really, really high quality of life that also has a city. I'm surprised it's taken this long, but what I think is interesting is that Jacksonville hasn't been known as a retirement place because it's got all this other stuff going on.
Right.
And it's been one of the 10 fastest markets growing in the country
Mhm.
without including retirees.
I just feel like Jacksonville has been the best kept secret for a long time, but you start to see articles that highlight this.
Yeah.
And I think it's very clear now when you look at population growth,
Yeah.
you see how much home prices and rents have risen, especially over the last few years, that the cat's out of the bag now. Like people look at Jacksonville as a destination.
Mhm.
It's not to its full potential, which I think represents a great investment opportunity for all of us,
Mhm.
but you start to see that the cat is out of the bag.
Why is that important to an investor? Why is this news relevant to me? I'm not renting to retirees.
If you want, people talk about this idea of a path of progress,
Mhm.
right? If you're an investor, you've probably heard that term. You want to invest in something that you're going to see higher than average growth over the next, market cycle. Well, when you are in a city that is making a step from being a tertiary city, maybe a third level city, which is where Jacksonville has been for quite a while,
Mhm.
to being recognized as a secondary city, right? What you really get to see there are median incomes going up, more jobs, and then the way that affects us as real estate investors, as population grows, there's more demand for housing, both on rents and prices. So when things like this happen and you start to see Jacksonville more and more in the news, that leads to population growth, that leads to better than expected returns on investment for you.
Man, the way that you've said it to me that I think is really brilliant is risk mitigation, right? Like if you live in a place where demand is growing, right? We talk about the pricing of homes as a supply and a demand issue, right? Like right now, the media is talking about how like demand is falling off a cliff because of interest rates, blah, 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 blah. We have always talked about like, yeah, cool. There's two sides of the equation. It's supply.
Right.
There's not enough supply in relative to the demand in Jacksonville. And if you hear more and more news stories about the demand in Jacksonville going from like, hey, always been great for families, always been great for fintech, healthcare, logistics people, all these other things, and now also retirees,
Right.
It is adding to that part of the equation, which I think is awesome.
Absolutely.
I say surfing because why is that, GC? Why do I bring up surfing all the time?
Love surfing. I don't know. Is there another reason?
Because when we sat down to talk about this show, I remember specifically saying, hey man, I think we need to talk about the story of Jacksonville. All these investment companies, all the like Prudential, look up like a history of Prudential Securities advertisements.
Right.
I bet you a third of them is some old dude about to go paddle out on the
holding
beach.
the surfboard, like standing up, looking like the picture of just calm and peace on his face.
Calm and peace on his face. And yet the places that you can do that are usually like Hawaii, California, Sydney, all these like Rio de Janeiro, all these like really expensive cities. In Jacksonville, old people surf. Like I surf with like 60-year-old guys all the time. They're like retired college professors. So I just think it's a really high quality of life place,
Way to give the surfing plug. It's impossible to not give the surfing plug.
I can't not talk about it, GC. All right, buddy. So now that I love what's going on here in the chat. Everybody's making fun of me. Now that we're there, GC, why don't we oh wait, you said you had two breaking news.
I do.
Dose.
Numero dose here for Bill Shields over there. Numero dose. Yeah, so we really care about holding ourselves accountable to the numbers on the property evaluations that you all invest in. At the end of the day, that's why you trust us. It's because we say we're going to do something and we do it, right? Well, we're always looking to see the rent numbers that we tell you on these evaluations. Are we hitting those rent numbers?
Mm-hmm.
And if we do not hit those rent numbers, that sets you up for failure, right? That is a terrible way to start an investment, right? And we make sure that we don't do that, right? In fact, we overperform versus the property evaluations. And this drives to the core, one of our core values of how we want to bring you on as a client. One of our core values is under promise and over deliver. So with all that being said, I wanted to share the data with you on what did we tell you rents were going to be for all of the homes that are moving in based on those evaluations, and where did we come so far this year. And on average, for all the homes that have been sold this year, like the one that we're going to be looking at here on the property of the week, and all the other properties you've seen, the ones that have sold this year and that have moved in, we're overperforming our property evaluations by $37 on average. Right off the bat, that's a 2.5% increase in rents over what you were expecting. And so I'm really proud of this. It gives me the confidence to come on this show and share with you all that when you make the decision to invest with JWB, we're going to hit your returns and you're going to be happy.
I was having a really good time with what's going on in the chat right now. Do you see what I understand is you guys are under promising, over delivering. It is your core value. You do this on purpose. And therefore, I don't even know why this is breaking news. No, but so what are the mechanics? Why is it that you're overperforming?
Well, we are conservative with our rent numbers, which is very different than how other real estate investment firms position their assets. You know, I am really confident that when I put a number on this evaluation, we're going to be able to hit it. I am confident because of that, or I'm confident because I've looked at all of our investor portfolios and we're performing for all of them. We are overperforming for all of them. And I don't know if that's overperforming because of rents are higher than what we told you to expect, or maintenance costs are lower than what we told you to expect. But at the end of the day, 100% of the portfolios we're managing right now are overperforming versus what we told you. So when we have the opportunity to start off a new relationship with a client and we tell them a rent amount should be this much, it is front and center in that client's mind. It is like a moment of truth right off the bat. Did you hit the rent that you said? And so that's why it's so critical for us to make sure we hit the number. And if we're going to be off, we better be overperforming. And that's what this number reflects.
Pretty awesome, dude.
Yeah.
Congrats, man.
Thank you, man.
Good couple of breaking news is there. While we were breaking news and talking about tacos and whatnot, we had a couple of people join. We got Christopher Lee from Fernandina Beach has joined us. Who else we got? We got our favorite name to pronounce, Aaron O'Neill, into the night. And who else do we have here? I saw a couple of other names. I'm messing this up. Man, I wanted to say it because it was some names that we don't always get to pronounce. But you're welcome to the show. Layla Powell. That's who I was looking for. Layla, good to have you here. All right, so GC, now let's. Oh, and Pedro Nacienteno from Jersey just showed up. Pedro, good to have you, man. You ready?
Game on.
Because we are going to magically whisk ourselves away here to 4903 Foxborough Road. And I am not going to bring up the fact that the Miami Heat are beating the crap out of Boston in the NBA in the Eastern Conference Finals, because I totally want to respect the Boston fans here, or that the Florida Panthers knocked the Bruins. Anyways, I'm not going to talk about that. 4903 Foxborough Road, Jacksonville, Florida, 32205. Purchase price of $300,000. I'm going to come back to that in a second. Monthly rent of $2,105. It's a 6-bedroom, 4-bedroom, 3,048 square foot house. Average duration of stay, 4.5 years. Annual appreciation rate, best in class for cash flow markets of 4.6%. And what us, not your average investor, actually care about, 13.27% IRR, with keeping in mind that JWB clients have earned 79% home price appreciation, higher than the average Jacksonville investor. But GC, enough about me. What do you love about this property?
I'm going straight to IRR on this one, because I look at the purchase price. I understand that, you know, some folks look at the purchase price first. If you want to be a successful investor, you have to train yourself to look at IRR, right? That's why you're investing, right? So your 13.27% IRR is one of the highest IRRs we put on this show. So 13.27 IRR. It is one of the very highest IRRs we have available at this moment, right? A lot of our IRRs are 11%, 12%. So I put this property here because I want to test your ability here, right? If you're an investor and you look at purchase price first, you might look at this one at $300,000 and say, oh, geez, you know what? That's too expensive. However, if you look at IRR and you look at the effect over a 10-year hold of a $300,000 asset producing 1 or 2% more every single year for you, it adds up to the tens of thousands of dollars of additional return on investment for you over the long haul. So I think this is a real challenge for our community, right? This is pointing out the importance of the IRR calculation, which at the end of the day, think of yourself as a financial engineer. Your job is to use the resources that you have to deliver the best risk-adjusted return. Your job is not to use the resources that you have to pay the least for properties. Some of you will get it, some of you won't, but that's the reality. That's what's helped me build my portfolio over 17 years. And so I think this is a good opportunity to really dive into that IRR.
That is a good opportunity, man, because the first thing that popped out to me here was this $300,000 purchase price. I don't think, have we had a property of the week at $300,000 before? I don't think so. Like we've
I don't
come
know.
close.
I remember 290 a couple of times.
Yeah, we've been in the 290s a couple of times. So the first thing that I think of is like, holy smokes, that's going up. But I then think that's pretty good because that means that the market is going up. If our average price of property here on the show continues to go up, it means that home price appreciation continues to happen. Is that kind of how you're seeing it? Is this going to be like more of a new normal here on the Property of the Week? We're going to start seeing more $300,000 homes?
I don't know. This is about the top end of the pricing scale. The only reason that we're able to bring this to you is because of the incredibly high rent.
Okay.
Right. So the fact that you have 6 bedrooms, 4 bathrooms, 3,000 square feet allows us to generate over $2,100 in rent right now.
Mhm.
And so it's very rare that we're able to generate that much rent in our neighborhoods. So that's really the reason why we have this opportunity. Most of our homes are smaller homes.
Mhm.
And so a smaller home would not be able to generate enough rent. Therefore, the purchase price would not be able to be so high in order to deliver a, call it 13% return on investment.
Got it. JC, we talk a lot about risk mitigation on the show and how like risk mitigation within the asset class of real estate is real. Risk mitigation within the city that you're in is real for Jacksonville. Risk mitigation within the workforce housing sector.
Mhm.
And that meaning that at a certain price point, rent starts to become disposable income, and being in these workforce homes is a way to mitigate risk. Is a $2,000, dollar rent still a risk mitigated income? Is like a 6-bedroom, 4-bathroom house still that?
Yeah, absolutely. It's in our bread and butter neighborhoods. It just
Mhm.
happens to be a higher rent because of the bigger home that you have and the more bedrooms. And the best way to know that this is risk mitigated is it's already rented with a long-term lease in place. In fact, let me bring up the lease details on it. So it was rented in March of this year. So it was just rented, and it's got a 2-year lease on it as well. And in March of next year, in March of 2024, the rent goes up again. It goes up to $2,155. So there's your risk mitigation right there. It's already rented and with rent escalations built in.
All right. I think, Lee asked the same question. Of course, he's the MVP. He was asking a very similar question of like risk mitigation, right? At 6-bedroom, 4-bathroom, 3-car garage is a huge house, but the rent at over $2,000 per month is also a lot. Does that limit the tenant pool and take longer to rent out?
Didn't take long to rent out this one.
Okay. Yeah, data flaggable.
I mean, to your point, guys, it's a little bit bigger than what's normal.
Yeah.
So those are really great questions. But that's why we're here. We're here to rent your properties out for market rate. And so when this home is in our neighborhood, it's a bigger home. We're able to get the rent that we need to deliver the returns for you as the client. And there are other homes that are similar, right? There are other homes that might be 1,700 square feet, 1,900 square feet, right? 2,500 square feet, 3,000 square feet. What you're able to do is to get higher rents, but the scaling of the rent comes down. So what I mean is, a typical property that might be, call it half the size of this, might still get, $1,500 in rent.
Mm-hmm.
So you double the size of the house, you're not able to double the size of the rent, right? But we're still able to get over $2,100 in rent, which again makes this IRR over 13%.
Yeah. So working class family, bunch of kids, you need a place to live. You're not going to be able to afford a 6-bedroom house elsewhere.
Absolutely.
So, this is where you go, right?
Supply and demand. There's less demand for 6-bedroom, 4-bath house
In this neighborhood at that price point.
in this neighborhood, but there's also a lot less supply.
Correct. Got it. All right. Speaking of financial engineers, our favorite fiduciary financial advisor, financial engineer, Kelly Barenbaum has a question. You have a new mayor today. Do you see her policies impacting your business or real estate in Jacksonville at all?
Yes, we're really excited for Donna Deegan to be our mayor. She is the first female mayor of the city of Jacksonville.
That's awesome.
And so we're really, really excited about her. We're excited. She is really committed to infrastructure. Well, first of all, she's committed to bringing the city together, which is wonderful.
Mm-hmm.
Any type of person in public service and leadership, I think, that's incredible. And I'm certainly behind that. But more than that, she's got great policies in terms of infrastructure. I know that's really high on her list. And of course, downtown development is really, really important to her. So we're super excited about it. And we have a great relationship with her and her team already. And, looking forward to strengthening that.
I wonder if we're going to get her on the show, GC.
I know, I
mean,
know.
This is a show where mayors come, right? We've had 2 past mayors at this point.
Actually, you know what? Her list of agenda items
Yeah.
in her first 100 days of mayor, get on the Not Your Average Investor show, bring people together, infrastructure and downtown. I think it's in that order. I'm not sure.
Got it. Nadeem already asking the question too. I know our community. I am you. All right. Billy Green has a question over here from the mountains of Colorado. No, he's a mountain man. He says, from JWB's experience, what would you estimate to be the average percentage of down payment that investors make on these purchases?
You know, over the history of JWB for the 17 years we've been in business, largely towards the 20% down. The overall majority would be 20%. And the reason is because your best return on investment comes from a 20% down investment versus 25%. However, in recent years, we've seen a lot more clients putting 25% down, sometimes even putting more down. And the reason that they might choose to do that is because they want more cash flow. When you put more of a down payment, that means your loan balance is lower. So your mortgage payment is lower every single month. So it creates more cash flow for clients. And as cash flows have come down in recent years, like we have been talking about and letting you know that they would, the premium for cash flow is important to some people. So what they do is they increase the cash flow by putting 25% down. They also decrease the overall return on investment by doing that, though. And we openly talk about the pros and cons of that. So 20 or 25 is absolutely what most clients do. And you know, it's best to look at your goals. And that's why if you have a question, talk to our team, because we can run that analysis for you. Long term, can you get enough cash flow without having to put 25% down so that you can get the max growth? Or is cash flow that important for you that we need to maximize it and maybe put a little bit more down?
Great question, Billy. Also, our MVP coming in as usual. He's saying at this property, $300,000, 25% down, you're looking at about a $75K down payment, right? You're looking to come up with 75 G's here. Pedro Ascensiano, who is clearly an expert in our community because he's gone and downloaded the property sheet that you can get at jwbinventory.com. If you want to see the background of these numbers, if you want to use it to break down your own deal evals or anything else that you're looking at, we have this awesome template that is fiddleable.
Why don't we just bring it up while I'm kind of talking through it? Right?
What? Okay.
No. Well, I want to encourage you because I want to show people where the seller concessions question is showing up on the eval.
That sounds good.
Did I overstep my bounds?
Greg says, why don't we bring it up? I hear, why don't we up the level of difficulty here? That's cool. Greg, I got a question for Pedro. May I ask about the seller? First of all, what I was trying to tell everybody is go to jwbinventory.com to download the spreadsheet because you can use it for all of your deal breakdowns and you can see all of the kind of like past properties of the week. Go to jwbinventory.com, download this thing, follow along at home. And now my question, Pedro asks, may I ask about the seller concessions of $6,000? Thanks.
Thank you, Pablo. Appreciate all of your efforts.
I feel
you're incredible. And Pedro, thank you for the question. So you know, the interest rates that folks are getting on their investment properties have been a hot topic for a year now, since the Fed has raised interest rates, I believe, 10 straight times. And by doing that, it has caused concern in the investing world, not just into rental properties, but beyond that. You've seen a lot of things become highly variable in this economy. And at the end of the day, when JWB sees an opportunity to be able to take some of that variability or that risk or that concern away, we're going to do that. Right now, the biggest concern comes in the form of higher interest rates on your loan. So, Pedro, that $6,000 of seller concessions is related to JWB buying down your rate for you so that we can make sure that you get the interest rate that we put on this evaluation. So thanks for bringing it up there, buddy. You're incredible. Look at you, buddy. You did so good.
I've done this a couple of times.
We're looking at the evaluation here, and it's built off of a 5.5% interest rate. Many of you might be saying, is that even possible? Well, in the normal way of buying properties right now, not possible. But when you work with JWB, because we have special relationships and we can actually buy down rates for you, this is possible. This will be the interest rate that you get for your loan. And how do I know that? It's because even if we have to provide a seller concession to do it from JWB's perspective, we're going to do that. So that's that $6,000. If it is needed for us to be able to get your loan down to 5.5%, we're prepared to spend that on your behalf. And that's where that is.
Got it. And just if you're following along at home here on the spreadsheet, you've gone to JWB Inventory, you downloaded it. There, it originally pops up in a summary tab, and you see kind of like the deal evaluation summary. And then down below is an analysis of cash and analysis conventional financing. If you pop those open, you scroll over to L9 bingo. Then you see the $6,000 price point here. You can also see all the different interest rates and whatnot. Do you see, is this a good time to, I find it really interesting that you brought up the other day that a couple of your approved mortgage providers have included these like stipulations that you're able to, if you were to get a rate today, they will allow you to refinance for free in the next 3 years for us. Can you talk through that one again?
Yeah. So our lenders are doing this. A few others around the country I've seen it are doing this. And what they're doing is they're betting that interest rates are going to be lower in the future. And they're making it really easy for you on an experience basis and also on a cost basis to plan for that future refinance in the future.
Mhm.
Double down on the future there. So basically what you do is you get your normal loan in like you would be for buying this investment property. And they already build in a discounted fee structure for you, assuming you're going to refinance that property at some point in the future. So all good things for you. You were probably planning on refinancing at some point in the future if you were going to get a 6.5% or 7% interest rate. So it's just kind of making it easier to do that, less costly to do that. The interesting thing here is at a 5.5% interest rate, that's a really good interest rate. I mean, people lack perspective, but the average interest rate on a 30-year loan over the last 40 years, according to Freddie Mac, is 7.8%. So this 5.5% interest rate, you may or may not want to refinance that down the line. And that's just a good thing. It's good to get in at 5.5%, which is a really good interest rate, historically speaking. But you probably will also have the opportunity to save a little cash flow when you go to refinance with the lender that we put you with.
Love that, man. I find that really interesting, GC, because for me, as I've said a couple of times on the show, right? Like I look at the landscape of where I can put money right now, right? Let's say I have $75,000 that I don't need cash flow from today, but I do want it generating wealth for me, generating cash flow tomorrow for me. And I look around and I'm just like, okay, what are my options right now? I can put it under my mattress and just get my teeth kicked in by inflation. I can put it into the stock market and go for the Tower of Terror ride at MGM Studios and see what's going to happen in the next, we're going into a weird part of the economy. Like I am really buying into all this like Ray Dalio changing world order stuff.
Yeah.
I think it's going to be really uncomfortable for the next year or two to have stuff in the stock market. Long term, it'll probably work. It's going to work. It's going to work out, right? Like proven less than rental properties, but like the stress of just like, should I sell it? Should I not? Should I stay here? Should I not? To me, I lose sleep over that. Bonds are not doing well right now, right? And not beating inflation. So then I think of real estate and I think of the idea that I'm like, all right, cool. If I can get into real estate, ideally, if real estate is, going to stay stable, likely go up, there is a chance that maybe it dips a little bit in the next 2 years or so. But if you can lock it into this like cash flowing asset that in the next 2 to 3 years is definitely going up, if you definitely think that interest rates are going to go down at some point in the next 3 to 5 years from where they are right now, then you have the opportunity to get into the real estate. And then when the interest rates do go down and demand goes way up again, you're already in and you're already in an advantage and you're not suffering from this higher elevated price. So I just find that to be a really innovative lever to pull by these mortgage lenders, man. I just think it's really smart.
Yeah, makes sense. I mean, everybody wins. They get more business, of course, down the line. They lock in that business, right? They give up a little bit of cost, but from their perspective, how expensive is it to find a new client? Right?
Yeah.
They're saving money on that trade. You get a win because it'll take that concern that you have off the table of maybe you feel like interest rates are higher than you want today. And of course you want to refinance in the future. Well, now you've got that kind of set, sign, seal, and deliver. One thing I wanted to pick up on that you've said a number of times, I don't think we've shed enough light on it, is that think about this, right? So the Fed has raised interest rates 10 consecutive time. They raised the Fed funds rate, which it raises long-term interest rates in an indirect fashion. The Fed has had to raise interest rates at an unprecedented level. They haven't done it to this level this quickly in 40 years. They have done as much as they possibly can to raise interest rates, right? And by raising interest rates, home prices and home rents are still performing, right? You still have over 3,000 sales a month happening in Jacksonville, which before June of 2020, we had never had 3,000 sales in Jacksonville, right? So real estate is still performing. They had to raise interest rates 4.5%, 5% over a, almost a year period of time, and real estate is still performing, okay? When they drop interest rates again at some point in the future, which everybody knows and believes at some point they will drop interest rates again, what do you think that's going to do to real estate?
It's going to drive the prices way up.
It's going to drive real estate values up. And the reason is right now because we have very little supply. So think about it from this perspective. The Fed's doing everything they can to tamp down the real estate market because we have very low supply. At the first sign that the Fed starts to decrease interest rates, demand for housing is going to go up.
Correct.
So you can lock in your interest rate right now, lock in your home price right now, lock in your IRR of 13%.
Yep.
And if you believe that there's a correlation between dropping interest rates and home prices going up over time,
lock that in.
Then you lock it in right now. You don't have to wait down the line to lock it in, and you get your asset at a lower cost basis.
Feels like we should give the mortgage companies a Not Your Average Investor Show triple win award for this one.
I like it. I think it works. I think
it works. The other thing that you mentioned, GC, that you don't mention enough on the show that I love to talk about is the idea of downtowns coming online, representing like just a different echelon from when it happens, right? Like I've lived this, which is why I like talking about it so much, is this idea that cities only go from dormant downtown to a live downtown one time.
Yeah.
Right? It'll only happen one time. It happens in specific cities that have like a specific dynamic. And, when it starts happening, everyone's like, oh man, I got to invest in downtown. Oh, I wish I would have bought this stuff downtown. But the truth of the matter is buying downtown properties is not for the average person, right? Like, in fact, it is for, it is for people with a ton of money, real estate development experience, accredited invest, like all these different things that are only open to a select few. But what also happens in those downtowns is that the areas around downtown, which are generally workforce housing areas, shoot way up and become, all of a sudden there's like a workforce housing lack of inventory. I've seen it in Miami, I've seen it in Nashville, I've seen it in all these different places. And we talk about downtown a lot on this show as something that is, like the embers are hot, the air is dry, the wind is blowing, there's about to be this like wildfire of development that's going to happen there.
Well, it's already happening.
And yeah, correct. It's already happening. And, once that happens, it's like all property values take a step up that never come back down.
Yeah.
So if I think about like, you combine that, the only reason why I would be like, maybe I want to wait is because of this mortgage rate thing. Like maybe I want a better mortgage rate, but the mortgage companies are taking that off the table. So it's like, if you can lock in this idea that like, hey man, I'm going to win off of downtown in the next 2-3 years and I can get in it today, to me, that seems like no brainer.
Well, I'm really glad that you picked that up, because if you're asking the question of why right now, like why right now is the time for you to load up on your investment portfolio here in Jacksonville, you hit the nail on the head. This is that urgency component. And it's the fact that if you look at other successful downtowns, like Nashville is a great example, right? 20 years ago, Nashville downtown did not look like Nashville looks today. And nobody was talking about it being the bachelorette capital of the bachelorette party capital of the world, or having the NFL draft hosted in Nashville, or this tourist destination, right? Similar to how people haven't talked about Jacksonville as being a tourist destination.
Correct. Or a retirement destination, or all these other things.
Or best places to retire. Very good, right? So, but if you look at Nashville, the same path that they have taken is the same path that Jacksonville is taking. And we're at an inflection point right now, because this isn't theory about downtown Jacksonville. Like, the money is already being spent.
Correct.
If you take a tour of downtown Jacksonville, like we do, like we brought our clients together on for our Not Your Average Investor tour. Many of you went on the tour. You saw lots of cranes, You saw things that were changing. I was able to take you inside JWB's buildings downtown and show you the change that is happening. And so here are some numbers to represent it. 7 years ago, we had $500 million of development going on in downtown Jacksonville, which sounds like a big number, except if you understand that right now we have $5 billion of development going on in downtown Jacksonville. And this isn't just like theory or proposed. No, this is funded. Some of those projects are JWB's projects that you all walked through and saw the $20 million that we had invested in those buildings. So when all of that change happens, it's very quick when a downtown turns from a place where people think it was unrealized potential to a place that people flock to. Mm-hmm. And when people start moving downtown because there are more amenities downtown, jobs and employers want to be downtown. And that raises median incomes. And the effect that I think the best risk-adjusted way to take advantage of a downtown is not to buy a downtown building, because that's risky.
Yeah. Or a condo, right? Like downtown, like apartment.
I mean, you want to find assets that cash flow and pay for themselves, where you're right on the outskirts of downtown. Yeah. Right? Buying a condo downtown right now does not pay for itself every single month, which is why I don't bring it to you guys. Yeah. But I find those neighborhoods that are right around downtown, which are risk mitigated. They pay for themselves every single month. But those are the neighborhoods that stand to see above average rent growth and home price growth. I think the best time to invest in Jacksonville is right now, and it's because of the effect of downtown. And there's a reason that all of your assets are going to be within a 10 or 15 minute drive of downtown. If you go and you look at Nashville and you look at those neighborhoods that are workforce housing neighborhoods within a 10 or a 15 minute drive, and you look at their rent prices and their home prices before the boom of downtown Nashville and look at it now, it's night and day difference. They've seen much higher growth than the average time to invest in Nashville. And that's what's going to happen here in Jacksonville. And that's why I think this is the time for you to be loading up and building up your assets in Jacksonville and hitch that wagon to downtown.
Just like Jen Filson, who just bought her 7th property, fairy godmother of the community. Jen, really incredible, man. Like Jen and Renee have made moves, boy.
You want to talk about an incredible success story? Jen and Renee, took a chance on us back in 2011 or 2012. Jen, you'll have to let us know when you started to invest with us. But they took a chance on us because we were a bunch of young folks. Yeah, that was what, 10, 11 years ago now.
You're still young to me.
Yeah, right. It's good that you say that. And our team was younger, over a decade ago. And, they just said, we think that you're trustworthy. We think that you can help us on a financial level and really help us accomplish our goals. And it wasn't just their trust. They were hearing from other people, hey, what are you doing? Is that crazy? You live in Monterey, you're investing in Jacksonville in a rental property. What are you doing? So they overcame all those challenges. And then they started to build their portfolio with us, had some incredible success in the beginning. But as this community really grew over the last 3 years, they've gone from, I think 3 homes to 7 homes. And those last 4 homes, I think, have happened. And Jen, you can correct me if I'm wrong, but I think those last 4 homes have largely happened in the last 2-3 years.
Money moves, man.
Right?
Yeah.
So you just talk about the value of this community, really kind of helping folks accomplish those goals, letting you guys know the best time for you to be taking advantage of it, which was really over the last 3 years. And I think right now with downtown is the reason. I'm excited to be a part of that journey for Jen and her family.
Cool. All right, GC, let's go back to some of these questions we got while we were pontificating out here. Michael Santorios asks, Greg, on the tax savings, you have $3,436. How did you come to that figure? I'll show you right now.
Absolutely. So tax savings are all around rental properties, right? You can, you earn tens of thousands of dollars in revenue for a rental property, right? That's your rental income. So if we're looking on the evaluation here, right, column F, row 20 there, that's $25,000 of revenue that you earn, rental income. Well, you get tax savings to be able to decrease that amount for what you pay taxes on. So write-offs, like your interest on your mortgage payment, your property taxes, your insurance, your vacancy costs, right? Your maintenance, your repairs, your tenant placement fees, all of these things. And there's a lot more write-offs than just that. But all that stuff reduces the amount that you have to pay taxes on, which is great. If you compare this to other asset classes, it's not like if you invest in a bond and you had some special bond, you don't get to write off your fees for your financial planner in your bond investment,
Yeah, that's right.
right?
That's right.
Or in the stock market, right? You don't have write-offs that reduce your revenue if you do earn a dividend in the stock market. So those write-offs are super powerful. But there's one additional write-off. And when we're talking about how do we get to that number that Michael's asking about, I'm specifically referencing one additional write-off, and that is depreciation from a tax perspective, not a market perspective, strictly from a depreciation from a tax perspective. And so what that means is that every year the IRS says, hey, listen, over time, your building's going to break. And we're going to give you a write-off every single year because over time it's going to break down. And whether or not you actually incur any costs that year, we're going to give you that write-off regardless. And so that's the general high level of that tax savings line item right there. That's that non-cash write-off, which we love. You don't actually have to spend the money. You just get this write-off because the IRS allows you to do it.
I'm surprised somebody asked something about taxes and you spoke for less than 12 minutes, GC. Good work, buddy.
Well, let me give a little bit more of an answer so I can fill up that 12-minute spot.
Talk about your all-time backfire.
Well, I think Michael was just asking, how do we get to that number specifically? So that number specifically, what you do is you take the building value. So you can't write off land because land's not going to break over time, but the IRS allows you to write off the building value. So what you do is you take the building value and then you divide that by 27.5 years because that's the depreciation schedule that the IRS gives you. And then you multiply it times the tax rate. And we estimate that our tax rate for our clients is 35%. That's how you get to 3436.
There you go. And that goes nicely with Arthur Haber, which I think is a new name.
New name.
Welcome to the community,
Welcome.
Arthur. He's asking, why do you factor in the appreciation and the tax bracket?
Ooh, great question, Arthur. Well, let's talk about home price appreciation. At the end of the day, I think one of the greatest misconceptions for investors out there is that they don't fully understand all 5 profit centers, right? You don't invest for rental properties for cash flow. That's never been the reason to invest in rental properties. Cash flow helps you stay in the game and mitigates your risk so that all 5 profit centers can grow for you. So if you're not factoring in home price appreciation, you're missing out not just on another profit center, it is the greatest component of your return on investment over a full market cycle. And Arthur, I hope you keep coming back to the show because many times we have clients that'll join us on the Thursday shows and we do a client journey. And through that client journey, I show all 5 profit centers and how did this client earn their return on investment. And then we put a pie chart together and we say, okay, out of all 5 profit centers, which is the biggest part of the pie? And every single time it's home price appreciation. Home price appreciation will count for 60 to 80% of your total pie of returns over a full market cycle. So at the core of it, home price appreciation is a big part of this decision to invest. And that's why you need to choose a team and a market that supports it. And that's why we include home price appreciation.
There you go. Okay, we had some. So Pedro is asking here in the chat. He's asking, what is the scope for a refurbished home? I think, oh, here we go. Can someone please give a rundown again of a refurbished home or repost the link with the details of the usual improvements? What are the usual improvements when you bring a home to market that's been renovated?
Yeah, so generally speaking, and this is really important, there is no deferred maintenance. So think about yourself as a real estate investor. If you're buying a property for yourself, and when I buy properties for myself, right, I buy it and I look and I say, okay, well, if there's maybe 5 years of life left on the AC, or there's 10 years of life left on the AC, or if it's a roof that looks pretty good, but there's no problems with it right now, do I fix it right now? Well, for myself, and maybe for you, if I'm owning the asset, I might not fix that for myself, right? Because I might be able to get more usable life of whatever that mechanical is, whether that's the roof, the heating and air, the plumbing, the electrical, or some other component of the home. So my standard for myself, and probably for you if you're an investor as well, buying for yourself, is probably lower, right? Because you get more usable life. But our standard for you as an investor is no deferred maintenance. That decision of whether or not to keep it, but know that it might go out in the next couple of years, or maybe 3 years or 5 years, that's a different decision that we make for you versus the 300 plus properties that I put in my own portfolio. So the first thing that goes into a renovation by JWB is no deferred maintenance. We make sure that our major mechanicals meet the thresholds for usable life, so that you're not going to get hit with a big bill in the first 6 months, the first year, the first 2 years. That's how we do it. So you want to make sure that roof, heating and air, plumbing, electrical, those meet those standards. And there are different standards for each mechanical, like for the roof, right? There needs to be at least 10 years of life for the roof, just as an example.
Yeah.
Beyond that, we want to make sure that the home can be beaten up by somebody living in the home for 4 or 5 years without reducing resident experience and without costing you money. So it's a different approach that we have. And I think it's just realistic for somebody, our team manages over $800 million. I know how this works. The idea that residents are not going to beat up your home is not real. They're going to live in your home for 4 or 5 years on average, and general wear and tear is going to happen. I would rather bring you on board, letting you know that on average, you're going to come out of pocket every time that a resident moves out to put money back into the home to get it right back into great rental shape. So we choose materials, and we get them at a really good cost. We choose materials that can withstand that type of a living situation without breaking down. And so that is another just kind of general mindset of how we renovate your home. Lastly, it just needs to be a great resident experience. So somebody needs to be able to walk into that home and know that this is somewhere they can envision themselves living for 4 or 5 years. And so we do nicer things on our homes than others might do. Like, for example, on our homes, on many of our homes, there's granite countertops. Right? That's not an expense that we have to do, and this is for new construction homes specifically. But if we have an opportunity to kind of have a little bit of a wow factor that helps increase rentability and also decrease costs like that, and it's not too much of a cost to JWB, we do those things. So there's the general. If you have specific questions about a renovation, again, reach out to my team, schedule a call. If you're interested in this home, be happy to walk you through the specifics on the scope of work for this one.
Quick summary. No deferred maintenance, AKA no need for update anytime soon for the major mechanicals, HVAC, plumbing, electric. Also the roof, which may or may not be called a mechanical. I don't, but you do. But it's part of the deal. High durability materials.
Right.
I think you missed one thing. You also put in high replaceability and easy maintenance materials, right? So like something that you can, if it gets damaged, you can replace a piece of it versus having to replace a whole floor. It's something that you look at.
Well done.
And then a little bit of sizzle.
A little bit of sizzle.
A little bit of sizzle. All right, cool. All right, man. Last question here. GC Lee, the MVP, has a question. Does Gregg and his team have a percentage at this time on their plan to have multifamily residences for all of their new acquisitions downtown?
Let me just read that one again.
Yeah.
A percentage of how many multifamily residences for all of our downtown acquisitions. So how many of our buildings downtown are going to have multifamily, like a mixed use component?
Correct. So catching up the community, JWB has acquired 19 city blocks. Is it up to 20 yet?
You keep saying 19, it's actually 20.
Oh, my bad. All right, so 20 city blocks in downtown Jacksonville, percentage of multifamily in there.
I don't have a percentage off the top of my head. There's a lot of really good folks that are putting that master plan together right now. So I don't know that we have a good percentage, but I can tell you that we believe heavily in mixed use. So I think you're going to see a lot of it. A lot of those plans are going to be shared more broadly in the coming months and year. And so I'm happy to share those plans with you guys. But yeah, mixed use should make so much sense to everybody.
Yeah.
Right.
Yeah.
You've got retail at the bottom that you need to support, which is bars, restaurants, and things like that. Who's best to support them than the people living above it? Right. So mixed use is a big component and something that we hope to deliver at a really high level to downtown Jacksonville.
Just for the record, that 19 to 20, Jen thought it was 19 too, but I underpromised, over-delivered. Now she's delighted. She's delighted. All right, Michael Santorio's last question. Does JWB currently or plan on having a way that portfolio owners can track the current age of major appliances to anticipate replacement before they fail?
Never heard that question. Never thought about that. Not so simple answer to your question. No, we don't have a plan for doing that.
Yeah, I'm glad you made that real quick. GC, you flew in right on time. Great show. Awesome property of the week. Next week, we are talking about cash flow killers, right? Like what kills the cash flow on your rental property, and why is that, GT? Why are we talking about that next week?
Because we got a class to let everybody know about.
Yeah, baby.
We've got a course that Pablo and I poured our heart and soul into. It has come from all of you and the interactions that we've had over the last 3 years. And we said, how can we take this 3-year journey that we've been on together and put it into bite-sized videos that go straight to the heart of answering the questions that you have as a newer investor or as a seasoned investor with JWB. And so this course is called the Not Your Average Investor's Guide, the smart way to invest in rental properties passively. And we would love for you all to be a part of it. We're going to be launching it on Monday, which is May 22nd. My team is super excited. This is the first time I've released a course.
Yeah.
Right.
Sure.
I've done all this education just, in this kind of realm or on a one-on-one basis.
Sure.
So I'm really excited to see how you guys feel about this course. And we would love for you guys to be a part of it. We're going to do something special for everybody in our Not Your Average Investor community. We would like for this to be sort of a soft launch, right? Something that we would like to give to you, ask you to be a part of. And the ask for you all would be to give us a ton of feedback and tell us what you like or what needs to be improved. So check your emails for everybody who's a client and who's a fan of the show. If you're not on our email list yet, please go to jwbrealestate.com and sign up. You can just request to view properties, and then you'll be added to our email list. And then on that email list, we're going to send out the opportunity to be able to take us up on the course. And we're not sure what we're going to charge for the course yet. We would love all of your feedback as well. But for everybody who's a part of our Not Your Average Investor community, you're going to get it for free. So thank you guys for the support and the feedback in advance. We're super excited about it.
Super pumped about it. I remember when we sat down to like map out the show and do all this marketing stuff. One of the first meetings, I was like, Greg, I think in your future, there is, when do we start becoming educators? When do you also start dipping your toe into that water? You're like, that's not for me, bro. But guess what? We're here.
I've said that a lot through this journey, right? I think I said that before. I was like, there's no way you'll get me on social media. There's no way you'll get me live doing a show twice a week. So yeah, just add that to the list of things that I was wrong on.
Cool. Maury Leitner says that is great. Looking forward to Monday. Maury, I can't wait for you to see it. Joel, I can't wait for you to see it. We really did pour our heart. So we had a lot of fun doing it, man. It's a lot like this, right? It's back and forth with some better graphics and some more planned out kind of like structured teachings. But it should work to A, if you are new here, to like catch you up with all the concepts. B, just break a bunch of it's kind of like Mythbusters, man. Like we're just breaking a bunch of paradigms of the average way of investing in properties that doesn't work for people, making sure that you are familiar with the smart way to do it, the not your average investor way to do it. So that way you can take advantage of these, once in a lifetime opportunities like Jacksonville coming online, or if it happens in another city, stuff that you're going to look for in any market that you're going to be like, right? It's the questions that you're going to want to ask as an investor, all these different things that I think everybody's going to get a ton of value. And this has been fun, man.
It's awesome, man. It's awesome.
That's
Thank
been a
you
good
guys.
one. Yeah, thank you. Thank you. We have almost 50 people still on here, and we can't do it without you, right? So if you want to take advantage of investing right now before downtown gets online, go to chatwithjwb.com and just start that conversation, because it takes a little bit of time. But apart from that, just don't be average. See you on Tuesday.
See you, everybody.